Welcome to Ask Davis. I am Davis, and on this channel we talk about retirement and personal finance in plain language. No jargon, no filler, just what you actually need to know. Today, we are covering one of the most financially dangerous gaps in retirement planning: long-term care. If you're in your 50s or 60s and you believe Medicare will handle your care costs when the time comes, this video will fundamentally change how you think about your retirement plan. Stay with me through the entire video because the steps I am going to walk you through at the end are the ones most financial advisors never take the time to explain. Let me start with a number: 80%. That is the share of retirees who have no meaningful funded plan to pay for long-term care, not because they are careless or irresponsible people, but because they were never given the full picture, not by their employer, not by their financial advisor, and not by the government programs they were told would take care of them. Today, I am going to close that gap with specifics. Here is the first thing you need to understand clearly. Long-term care is not the same thing as health care. People use these terms interchangeably, and that confusion is exactly what leaves so many families financially exposed. Medicare, the federal health insurance program available to Americans at age 65, covers hospital stays, doctor visits, outpatient procedures, prescription drugs, and short-term skilled nursing facility care after a qualifying hospital admission of at least 3 days. What Medicare does not cover, and I want you to hear this clearly, is custodial care. Custodial care is the kind of ongoing assistance that most people actually need as they age. Help with bathing, help dressing, help moving safely from a bed to a chair, help managing daily medications, help with meal preparation, toileting, and being monitored throughout the day to prevent falls and emergencies. That is custodial care, and Medicare will not pay for a single day of it outside of very specific and time-limited conditions. Medicare does cover skilled nursing facility care for up to 100 days following a qualifying hospital stay, but only for the first 20 days at no cost. From day 21 through day 100, you pay a co-insurance amount that in 2024 runs over $194 per day. After day 100, Medicare coverage ends entirely, regardless of whether you still need care. This is the point where most families realize they were not as protected as they believed. The numbers every retirement planner needs to carry in their head are these. According to the most recent National Cost of Care surveys, a private room in a nursing home now costs approximately $108,000 per year. A semi-private room runs around $94,000 annually. An assisted living facility which provides housing, meals, and personal care support averages around $54,000 per year. And if your goal is to remain in your own home with the help of a professional home health aide working full-time, that costs roughly $62,000 per year at national median rates. These are not premium figures for luxury facilities in high-cost cities. These are the national medians. In many metropolitan areas, the actual costs run substantially higher. Now layer those numbers against the typical financial picture of an American approaching retirement. The median retirement account balance for households between the ages of 55 and 64 is approximately $185,000. That is the total accumulated savings for the median household in their peak earning years, not a surplus cushion on top of their retirement income. If a nursing home admission happens at age 75 and lasts the national statistical average of 2.5 years, the total bill at current rates approaches $270,000. For many households, that figure alone represents the entirety of their retirement savings, gone within a few years of a single health event. And here is the statistic that puts this in full context. The United States Department of Health and Human Services has estimated that approximately 70% of Americans who reach age 65 will require some form of long-term care services at some point during the rest of their lives. 70% is not a worst-case projection you can reasonably ignore. It is the expected statistical outcome for the majority of people in this audience. Planning as though you will be in the 30% who never need care is not a strategy. It is a wager with your financial security. There is also the Medicaid question, and I want to address it directly because it comes up every time this topic is discussed. Many people assume Medicaid is a reliable safety net that will step in to pay for care once personal savings are exhausted. And in a technical sense, that is true. Medicaid does fund long-term care for those who meet the eligibility requirements. But what most people do not fully understand is the price of qualifying. To access Medicaid for nursing home care, you must first spend down nearly all of your personal assets to a countable asset limit that in most states sits around $2,000. Your retirement accounts, your savings, your investments, most of it must be depleted before Medicaid will cover the cost of your care. Beyond that, your home may be subject to estate recovery after your death, meaning the state can file a claim against your estate to recoup what it spent on your care. And Medicaid accepting facilities, while they exist in every state, are not uniformly comparable in quality or availability to private pay options. Relying on Medicaid as a retirement care strategy is not planning. It is a last resort that carries real financial and personal costs. I want to pause here for a moment. If you are in your late 50s or early 60s, and what you have heard so far is making you realize that your retirement plan has a gap you did not fully account for, I put together something called the 90-Day Protocol, Retire at 62 Without Regret. It is a step-by-step system built for people in exactly this situation, working through the real planning decisions that protect retirement income, reduce exposure to unexpected costs, and create a plan you can actually execute. The link is in the first comment below. Take a look when this video is done. Now let me give you the action framework. There are 6 specific steps that apply to most people watching this video, and I am going to walk through each one with enough detail that you can take action on this immediately. Step 1. Assess your actual exposure with real numbers. This is not something most financial plans include, and it should be mandatory. Take your current retirement savings projection, what you reasonably expect to have accumulated by the time you are 65 or 67, and run a deliberate stress test. Assume 2.5 years of care at the national median cost for either assisted living or nursing home care. That calculation produces a figure somewhere between $135,000 and $270,000, depending on the level of care required. If that figure would eliminate a significant portion of your assets, or if it would leave your spouse financially compromised in your absence, you have identified a long-term care gap that requires a solution. Write that number down. That is what you are planning against. Step 2. Understand what traditional long-term care insurance is and why the market has changed. Traditional standalone long-term care policies, the kind sold widely throughout the 1990s and early 2000s, were designed to pay a daily or monthly benefit for qualifying care costs. They provided real protection. But the insurance industry badly mispriced these products because the actuarial assumptions about how long people would hold policies and how long they would live in care turned out to be significantly wrong. As a result, most major insurers have either exited the standalone long-term care insurance market entirely or have implemented dramatic premium increases on existing policyholders. If you currently hold a traditional policy, your first step is to review it immediately. Confirm your benefit period, your daily benefit amount, whether you have an inflation protection rider and what rate it uses, and the current financial strength rating of the company that issued it. These details determine whether your policy still provides meaningful protection or whether it has been eroded by premium increases you may not have been able to afford. Step 3. Evaluate hybrid life insurance and long-term care policies because these have become the practical replacement for traditional coverage in today's market. A hybrid policy is a permanent life insurance contract with a long-term care rider built into it. The structure is straightforward. You pay a premium, either as a lump sum or in annual payments, and the policy provides 2 potential benefits. If you never require long-term care, your beneficiaries receive a death benefit when you pass. If you do need long-term care at some point, the policy pays out a benefit, typically calculated as a multiple of your premium paid, to cover those costs. The core advantage is that your money serves a purpose, regardless of what happens. A 55-year-old in good health who places $100,000 into a well-structured hybrid policy might access a long-term care benefit pool of $250,000 to over $300,000, depending on the carrier and policy design. The specific numbers vary, and you will need to compare actual policy illustrations, but the principle is sound and the market for these products is active. Step 4. Apply while you are still healthy and do not delay this decision. Both traditional and hybrid long-term care coverage are medically underwritten, meaning you must qualify based on your current health status. Conditions like type 2 diabetes, heart disease, a history of stroke, cognitive impairment, or significant mobility limitations can result in a declined application or substantially higher premiums. The ideal window to apply for this coverage is between age 50 and 60. The premium at 60 is meaningfully higher than at 55, and at 65, a growing percentage of applicants face declined applications due to health history. Waiting to address this feels safe because nothing is wrong yet, but that is precisely the wrong logic. You apply for coverage when you are healthy enough to qualify, not when you need it badly enough to regret not having it. Step 5. Build a self-funding reserve if insurance is not a viable path. For some people, those who have already passed the optimal application window or who have health conditions that limit eligibility, self-funding becomes the primary long-term care strategy. Self-funding does not mean simply hoping your savings are enough. It means deliberately designating a specific pool of assets as a long-term care reserve and managing that pool with intentionality. A health savings account, if you still have access to one through a high-deductible health plan, allows you to contribute pre-tax dollars and withdraw them tax-free for qualified medical expenses, including long-term care. A Roth IRA provides tax-free access to qualified distributions and has no required minimum distributions during your lifetime, making it a flexible reserve. A conservatively invested taxable account held entirely separately from your primary retirement assets can serve the same purpose. The goal of the reserve is to ensure that a care event does not force you to liquidate equity positions during a market downturn or disrupt the income-generating assets your household depends on. Step 6. Have a direct, honest conversation with your spouse and your family about your care preferences before a crisis makes it impossible. This is the step people avoid most consistently, and it is the one that causes the most damage when it is skipped. The average American family caregiver provides over 40 hours of unpaid care per week. That is a full-time job, typically held by an adult daughter or daughter-in-law who simultaneously loses income, career advancement, and her own retirement savings in the process. If your current long-term care plan even implicitly assumes that a family member will provide care without financial compensation or formal support, that plan has significant hidden costs. The care recipient often does not realize the burden they are placing on the caregiver. The caregiver often does not feel entitled to voice the financial and emotional toll. A conversation held now around a kitchen table about what kind of care you want, where you want to receive it, and how it will be funded is worth more than any financial product I can describe. Make it a real conversation, not a topic that stays permanently on the list of things you will get around to eventually. Here is the bottom line. Long-term care is not a vague future risk that belongs in the same category as things that probably will not happen to you. It is a quantifiable, statistically probable event that affects 70% of Americans who reach 65, carries costs that run into the hundreds of thousands of dollars, and occurs during the period of life when your ability to earn additional income is gone. The planning window is open right now, but it closes based on your health, not your schedule. Medicare will not protect you from this cost. Medicaid will cost you everything before it helps you. And your family, however willing, should not be the default plan. The only reliable answer is a deliberate decision made with accurate information while the options are still available to you. I would like to hear from you. Leave a comment below. Have you already taken steps to plan for long-term care costs? Or is this something you are realizing you need to address? Tell me where you are in the process and what your biggest question is. I read every comment. If this was useful, please subscribe and leave a like. It helps the channel and it means more content like this one. This is Davis. I will see you in the next one.